So as you know, markets have declined sharply during the past year. This is the South African all-share index. And you can see there, from June last year till October, the market declined by 45%. Quite a significant decline. Thereafter, we've seen some stabilization, and I would like to call it, from technical analysis, a double bottom. And thereafter, some sort of a recovery. As of late, it wasn't so good, up 5% now. We haven't made a new low yet. And I would like to think that this will hold. I still believe that this is going to hold, the market trying to turn and to go up again. But we aren't alone. The purple line there in the bottom is China, down 58% now from the beginning of January 2008. It was down, that market is down 58%. The Dow Jones, the blue line, down 45%, and us then down 34%. So they have had extensive declines in those equity markets. And China, I mean, who would have expected that to happen? Down significantly. But since November, that market has turned around already, up from about up 25% from that low of it that it's hit in November. But certainly the markets worldwide has been in a huge decline. In the USA, the markets have gone nowhere during the past decade. And that is the S&P 500 taken back to 1997, and it's gone back all the way to that level. I don't think that we realize to the extent of the decline that we've seen as of late. And we can really call this the lost decade. It's a matter of confidence. There is no confidence in the world economy at this stage. So what we see really is a problem with economic growth in the world, and policymakers are battling to get that economy to grow again. Consumer confidence in the US, disappointingly low. You can see there, lowest, that measurement, this measurement specifically, is the lowest since the measurement has started. It sits at a level of 25. We needed to go back to 90 before we can feel confident again about the US economy. Currently, there's nothing going on there, and they're battling to get consumers to spend again. But then the media, and there are some people from the media around here today as well, but the media is really playing a role in affecting our confidence. The media is writing about these things. They are telling us how bad it is, and that people are, of course, there are people losing their jobs, but still they are focusing on all these negative factors and not wanting to sort of give any positive, or won't give us any of the positives that do come through from time to time. But let's have a look specifically at the period 1970 and in the early 80s. And I'm going to refer back to the period in the 1970s because I really believe what we're seeing now can really be related back to the 70s instead of the 30s. Because a lot of people would tell us that what's happening here is going to be a repeat of the 1930 to 1933 depression. Let's have a look at the 70s and see if we can find some comparisons between the two periods. First of all, in 1973, we had the media telling us that in 1973 the bulls will control the market. Business Week there, that in the background, that's the Dow Jones in the background there. And you can see there at the top of the market, the media become very optimistic about the outlook for equity markets. And then in 1974-75, at the bottom of the market in December 1974, how bad a slump. And then it was at the turning point when they said that. Then the market just rallied up to 1977. Our year-end panel sees a further rise in stocks, once again at the top of the market. And then the death of equities by the Business Week. And it's very well-regarded magazines that we talk about here, saying the death of equities. Then into the 80s, early 80s, Wall Street, bad news for the bulls. Perhaps not that significant, that one, but the very significant one, the 1982 one. Stagnation and inflation raised the haunting fears of a prolonged global slump. At that point, let me just tell you, I was, as you've heard, I was an analyst equity analyst for Sanlam, and I was doing work on De Beers at that stage as a junior analyst, doing the spade work for the more senior guys. And at that time, we were recommending to Sanlam to buy De Beers. It was after they've just cut their dividend for the first time in their history, like Anglo's has just done, passing their dividend for the first time in its history. De Beers at that stage, in early 82, cut their dividend for the first time in its history, and it was bad news out there. The sentiment was extremely negative. And at that stage, the late Mr. Marinus Darling was the general manager for investments at Sanlam. And he then and he was reading a book at that stage, once again the media, he was reading a book on diamonds are not forever. And he came back to us, and despite us then at that stage recommending Sanlam to buy De Beers, he sort of instructed us to sell all the De Beers shares for Sanlam at the low point of the market, in that point, July, must have been July, in July. And we sold the last shares at R3.96, 94, and 6 months later, that share price was at R8. And that's what can happen to you if you allow yourself your sentiment to be affected by what you read in the press. But there are three scenarios that I like to think that could happen here if we look at this. One is, and there's certainly some people that thinks like that, is that the US is in a depression. That these support packages will not be successful, and that confidence and economic activity may decline further. Are there some of you that think that this could happen? Yes? You think so? That this is going to happen? Some of you may think like that. And I think this is what the press is trying to tell us at this stage. I think there's a 20% chance that could happen. Not a big chance, but certainly if we don't succeed in turning this around, and if we don't succeed in turning or helping prices to start to rise again, in other words, get some inflation going in the US, this could happen. There's another one, that the economy just surprises and recovers ahead of the consensus that we're currently faced with, and that things just sort of get going again now. And there are certainly some people that think that can happen, because if you read through whatever some analysts would tell you, they say, well, inflation is not going to become a problem again, but we will see some inflation, lowish inflation. And if that's the case, and these interest rates start to work, then that economy will resume its growth path, and that, I think there's a 20% chance of that happening. But the one that I really give a higher probability to, is that the economy will recover, but then encounter some supply constraints. Why? Because everybody is now cutting back. You've seen those Baltic Dry Index. There's not a lot of production taking place in the world. Whatever you hear is that sort of production is cut back, people is laid off, they must go on leave for a month or two. They will not, if this economy starts to recover, there might be some problems with inventories. Any of these scenarios and parts of it can happen at any time. But typically, low inflation to be with us for, say, the next 6 months. But thereafter, if there is some sort of a recovery in demand for that inflation and those prices to get going quickly thereafter. Why do I say that? Let's use this as the example. In 1973 to 1976, this is the comparison that I would like to make. What you can see here is the USA so-called composite leading indicator of economic growth. A huge decline into 1974, hitting a bottom there in December, January, February of 75, and then an improvement again. At that point, there was also a lot of negativity in the US. First of all, they also had a property bubble at that stage, a commercial property bubble compared to now a residential property bubble, but a property bubble that burst in that period there. They had the first oil price shock, remember, in the early 70s. In that period, 300 US banks went under. I don't think we were aware of that it was so negative in that period. Interest rates were cut. There was huge government spending to get that economy going again. Unemployment was on the rise. If you read about press reports those days, early 75, first month of January 75, they were just reporting on how bad it was out there, how bad the unemployment was, how bad the outlook for motor car sales and things were. There was extreme negative news flows in that specific period. Nixon resigned in the third quarter resigned third quarter 1974. Just imagine the negativity in that economy in that period. And then the Dow declined by 40%. A very similar period to our period now. 1973, a slowdown in economic growth, a recession into late 74, first quarter 75, then a recovery. Now, our period now, 2007, a slowdown in world economic growth, all the negative news coming out of banks going bankrupt and so forth, a recession the final 2 quarters of 2008, perhaps some more recession in the first quarter of 2009, and then some sort of a recovery building up. That's my scenario, as you've asked me when. That's part of the scenario. Is it going to be different this time around? Remember, it's never different this time around. All right. In the money market, we know that rates will decline further and the so-called reinvestment risk exists. So if you are making use of fixed deposits, you're now getting perhaps 10 or 11%, say 11%. In a year's time, you might only get 8 or 9%. So be aware of that. In a capital market, rates have already declined substantially so, and is really discounting an inflation rate of 3.2%, which is on the low side. I think we've all agreed with that. But be careful and watch out for inflation to surprise on the downside. In the listed property market, that market has already recovered well, but the risk exists that the correction in the capital market to the wrong side now may affect that asset class negatively. But if it happens, make use of price weakness to buy. And you know, my view on the equity market is that even though company profits may come under pressure, our market is relatively cheap in spite of this fact. Lower interest rates and a steady recovery in commodity prices, as I do expect, should support the market in 2009. And then in final summary, there are a number of positives. We've seen copper is improving. That so-called volatility index is normalizing. Government bonds are normalizing in the US. The yield on corporate bonds, once again, is declining, once again pointing to a more normal environment. The so-called Baltic Dry Index is rising. That spread between corporate and government bonds has normalized. Interest rates in South Africa is on the decline, and we expect more. I suppose we can expect another, say, 250 to 350 points cut in interest rates. Our equity markets are cheap, but there are certainly a number of negatives. Your point. The consumer spending is still extremely negative. They are battling to turn that around, and inflation, deflation in the US is still a concern. Baie dankie.